Good morning. These are the things that matter most in Europe's market today. AI data centers are moving from growth story to power grid fight. U.S. debt management is still trying to calm the bond market. Japan's yen intervention is changing carry trade risk, and Asia's AI chip momentum still needs European order proof. The central question is simple. Can Europe keep rewarding AI infrastructure and banks if power costs, bond yields, and currency volatility force investors to ask which companies actually convert the headline into cash flow? Start with AI data centers. CNBC reported that outrage over AI data centers is showing up in ads and elections. That matters for Europe because the AI trade is no longer only about chips and software. It is also about electricity, land, grid connection, cooling, and local permission. The cleaner side is Schneider Electric, Siemens Energy, and Legrand if power equipment, grid upgrades, and data center electrification keep converting AI demand into orders. ASML and ASM International still matter, but they need the same proof layer, backlog and pricing, not just AI enthusiasm. Pressure sits with power-hungry developers, weak utilities, and real estate projects where local opposition or grid delay turns growth into a cost problem. For private investors, the hidden mechanism is permission. AI capacity is valuable only if the system can power it, connect it, and defend the economics. Second, the bond market is calmer only on the surface. CNBC reported that U.S. bond intervention is like paying a mortgage with a credit card, according to J.P. Morgan's Bob Michelle Sullivan quote. MarketWatch also framed the bond market as sending a troubling message. There is no easy fix for U.S. debt. For Europe, the cleaner side is BNP Paribas, Santander, and UniCredit if yield curves support net interest income without breaking credit. Pressure sits with leveraged real estate, rate-sensitive infrastructure, and long-duration growth, where financing costs still decide valuation. For private investors, the filter is not whether officials can smooth one auction or 1 week of yields. The useful question is whether funding costs really fall for companies that need cheap capital. Third, currency risk is back in the transmission map. CNBC reported that Japan's historic yen intervention has turbocharged the carry trade. A carry trade can support risk assets while it works, but it can also unwind quickly when currency volatility rises. Europe has to read that through banks, exporters, and luxury demand. The cleaner side is quality banks and globally diversified exporters that can absorb FX movement. Pressure sits with crowded carry-sensitive risk trades and companies exposed to a sudden shift in Asian consumer or funding flows. For private investors, the takeaway is that FX volatility can move European equities even when the original headline is in Tokyo, not Frankfurt or Paris. Fourth, the AI hardware signal is still alive, but narrower. CNBC reported that Taiwan's AI-fueled forecast of 11% GDP growth may not be sustainable, while Investing.com reported that Samsung shares climbed on reports of a shareholder return plan exceeding $72 billion. That is important for Europe because AI hardware strength is real, but it is not unlimited. The cleaner side is ASML, ASM International, and semiconductor if Asian chip spending translates into European equipment and packaging orders. Pressure sits with weaker semiconductor labels, automotive-exposed chips, and hardware names that cannot show pricing power. For private investors, the filter is proof quality. Asia's AI boom helps Europe only where orders, margins, and capex plans confirm the chain. Here is the stock-led watch list. First, Schneider Electric, Siemens Energy, and Legrand. Does AI-powered demand become orders or local backlash? Second, ASML, ASM International, and semiconductor. Does Asian chip strength reach Europe suppliers? Third, BNP Paribas, Santander, and UniCredit. Do yields support banks without raising credit risk? Fourth, Vonovia, Cellnex, and rate-sensitive infrastructure. Does financing pressure stay visible? Fifth, Volkswagen, BMW, and Stellantis. Do FX and Asia demand shifts change the exporter read-through? Market bias. Europe can open selectively constructive if AI infrastructure and banks show proof, but the setup is fragile if bond yields, power costs, and FX volatility rise together. The mistake to avoid is treating AI, bonds, and currencies as separate headlines. Today's market is about transmission, power permission, funding cost, and currency flows decide which companies really benefit. That is the Europe Morning Market Brief for Friday, 21st August. Watch the proof, not the label. Research context only. This briefing is not investment advice, not a trading recommendation, and not personal financial guidance. No price targets, stop losses, position sizing, or portfolio instructions are provided.